Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. It's Monday morning. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The government is set to push for greater supervision over the RBI's functionings at the board meet today. In global news, US Vice President Michael Pence says his administration is in no hurry to end the trade war. British Prime Minister Theresa May will reach out to business leaders seeking support for her Brexit plan as she takes it to Parliament this week. And ICRA puts Yes Bank's long-term credit rating under watch, citing challenges in the near future for the lender to raise funds. And then some result reactions and some stocks and news. Lots to monitor, but I think the news actually on both counts, both local and global, is very, very important. Let's just first take stock of what's happening around the world. So post our markets closing on Friday, over the weekend, a couple of developments on the trade war, quote-unquote, front that might not please people. So the APEC did not issue a joint statement at New Guinea after the US-China spat over language in the final half of the statement, and that would probably lead people to believe that all might not be hunky-dory when the two nations meet at the G20 towards the end of this month. In fact, Mike Pence, the US Vice President, kind of compounded matters. A number of strongly worded statements. He says that the US is not in a rush to end the trade war, said that the US would not change course until China changes its ways, and he called for nations to avoid loans that would leave them indebted to Beijing. This was in reference to the One Belt, One Road project and some other projects as well. And we all know what's happening with the Chinese influence over some of the other infrastructure projects across the country, across the world rather. I think the US statement was in reference to that. But all of this leads one to believe that when the two leaders meet at the G20 later this month, maybe just maybe people shouldn't expect too much to happen, which could be conducive to global trade. If anything, there are more trade tensions now, or more tensions now with regards to trade between the US and China than there were over the last 6 months, any given point of time. It didn't weigh in on the US markets though, because all of this of course happened post the markets closing. But if you just take a look at what the US markets did in Friday's session, very mixed trade, save for the Nasdaq. The other two indices started off okay. And the world markets as we speak in today's session are having a tinge of green. There's GX Nifty 2 pointing towards a start which might be marginally in the green, about 0.5%, 55 points, which is not unwelcome. But that's been the story, isn't it? The last 1.5 months, it's been a story of decoupling. Look at what happened last week on our markets versus the developed markets as well. The Nifty returned about 1% higher. Look at what happened to Dow, the S&P, the Nikkei. All the developed markets had a pullback, about 3.5, 2.5 respectively. And there's a chart that I'm using from one of the Bloomberg stories which shows this decoupling quite starkly. Look at that white line, that's the MSCI EM, and the blue line is the developed market indices and the US markets. And there's clear decoupling in the last 15-odd trading sessions when the EMs at large, and not just India, are moving up and the world markets are not, or the US markets, the developed markets are not doing that. So there's a bit of a decoupling that's happening any which ways, and last week was again a reminder of that. The Nifty led the move. The Nifty Bank, in fact, led the move for the markets this time around, and it was a third week of gains for our markets. The FI flows are net positive, even after you discount for the Kotak block deal. If you just look at what the FI flows have been the last 5 days, it's a net positive. So, well, good news on that front as well. One only hopes that it doesn't reverse post the RBI board meet today. I think that remains for our markets the single most important thing that we have to watch out for. So do stay tuned to Bloomberg Quint or all forms of media, to be honest. I won't be partisan here. You just got to get as much information about this very important, crucial board meet. We, of course, at Bloomberg Quint will try and give you all the information during the course of the day as and when we get confirmed information of what's happening at the RBI board meet. That remains, to my mind, the single most important thing to monitor. However, while that will happen during the course of the day, maybe in post-market hours, what will likely react at 9:15 a.m. on Indian markets today? Well, it is a difficult job, to be honest, because there are not too many newsmakers, but I've tried and chosen 3 or 4 names which I thought were important. So Bhatia Airtel, remember the stock had a big bang move in Friday's trade, up about 9%. In the analyst meet, they have said that the ARPUs mostly bottom relative to the current market prices. They believe there is an opportunity for Bhatia individually to increase market share given the integration challenges of Vodafone Idea and what they possess. And they believe that the non-mobile revenue growth in teens is possible. So they've given reasonably strong commentary. The stock was up about 9%. Vodafone Idea itself was up about 15-16%. Let's see what happens in the session today post these commentaries. Deutsche Bank came out with a note on tire companies. Remember, Yatin did a very interesting piece on tire companies and what could be the reason why these stocks might be doing. They believe that there is continued volume growth across companies. The price hikes taken to counter commodity cost pressures as well, which the companies have been able to pass on. They forecast an EPS CAGR of 16 to 26% for their coverage universe. And Apollo Tires for Deutsche Bank remains the top idea within this tire space. Let's wait and watch. They've had a reasonably good run in the recent past. Let's see if that continues. Then a small company, Sesashai Paper, and in line with what's happened to some of the other paper companies, very strong numbers, sales up about 45%, EBITDA margins 24.7% versus 21%, net profit up 92% at 50 crores versus 26 crores. So very strong number. Again, as I said, in line with what almost all the paper companies have done. An important sector to watch out for, an important stock to watch out for in the session today. Not the most liquid of names and therefore could see a stark reaction. Lastly, Siemens, 2 days of gains, and now we know with reason. Look at the numbers. The reported revenues up 25%. They were at 3939 crores versus estimates of 3141 crores. These are all versus estimates. Keep that in mind. The net profit at 623 crores. Versus estimated numbers which were much lower. The reported EBITDA for Siemens, and that was up 32% at 419 crores versus estimates of 346 crores. And last but not the least, the margins were at 10.6% versus estimated margins of 10%. So versus estimate, all of these numbers have looked very, very robust. I wouldn't be surprised if Siemens reacts or doesn't react negatively or doesn't come off a bit, because while the stock has had a 10% uptick the last 2 days, the numbers kind of justify that kind of a price movement. So do watch out for Siemens as well in the session today. So these are 3-4 names that I believe could react this morning. But let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we believe we should bring to you. Vrishti Benwal takes us through what the government representatives are going to present at the table when the RBI Central Board convenes today. That's the most important thing, as I said. Then we talk about cement, and we see whether or not cement makers' investments will pay dividend. Nikki Johnson to tell us why and how. India's moving up the value chain as far as the liquor markets are concerned, and that's reflecting in the liquor makers' numbers. Agam weighs in on that. And lastly, a stock that's lost out quite a bit in the recent past, Page Industries. It's lost the reins of late, as I said, with the jockey franchisee brand holder in India faltering in trade. I'll just dwell a little bit on the valuations in the way ahead. But to the most important story for the day, the Indian government wants closer supervision of the central bank. The Modi administration has recommended that RBI Central Bank Board draft regulation to set up panels which will oversee the Reserve Bank's operations. People in the know have told Bloomberg News that these proposals may be brought up at the board meeting today. Vrishti Benwal of Bloomberg News Johnson now with more. Vrishti, so what does the government have in mind?
So this RBI board meeting today, all eyes are on this meeting, which used to be a dull affair in the past. Tensions have escalated between Finance Ministry and the RBI on a range of issues, including flow of credit to the sector, as well as how much reserves RBI should keep with itself. Adding to that tension is a proposal by Finance Ministry which says that they want closer supervision of RBI, and they want to oversee functions like financial stability, forex management, and monetary policy transmission. So this and other issues that they have been discussing in the past are again likely to come up in the board meeting today, and everybody is closely tracking that board meeting, including market and investors. If the government pushes for a closer supervision of RBI board and other proposals on credit flow and reserves, and RBI doesn't agree, then it'll undermine investors' confidence. But clearly both RBI and the Finance Ministry would not like to undermine investors' confidence, and they might try to reach a middle ground on this.
Interesting. Now, Rishi, almost, I mean, we threw a series of explainers on the site as well, and I urge viewers to actually go in and check that. But we threw a series of explainers that have tried and explain the 4 or 5 key points that stay in focus. Aside of this increased oversight, the dividend payout or the reserves mobilization one, and the prompt corrective action being the other one, is there something else that you believe you individually would watch out for from the meeting today?
So as I mentioned, these are the key points. Finance Ministry is saying that RBI should set norms for how much reserves it should keep with itself and how much it should give to the government, and they want it to be in line with international standards. So that's a key flashpoint between the two. And the other issues are how much credit flow or liquidity should be available for MSME sector. Government's representative on RBI board, Guru Murthy, he has been pushing for this cause. He gave a speech last week where he mentioned how MSMEs are important for India's economy and should not be ignored. So again, the government is going to push for MSME liquidity.
Watch out for all of these issues, maybe 3 or 4 large ones. Rishi, thanks for joining us this early in the morning and getting us up to speed with what should one watch out for and what could one expect as well. Here are former bureaucrats, economists and market experts had to say about the government RBI tussle ahead of the central bank meet today.
Maybe the government is trying to fill its fiscal coffers by extracting money from the cookie jar. There might be some truth to the statement that there are excess reserves sitting on the RBI books. When Arvind Subramaniam raised this 2 years back, even today, the June 2018 RBI balance sheet shows that RBI actually has about 27% of balance sheet as its capital and reserves, which is probably amongst the highest amongst the world. If you include the revaluation reserves, which is a big if. Now, that doesn't necessarily mean that you can extract that money out of the RBI balance sheet and take it as fiscal income. And the reason for that is, remember, RBI on the other side also lends money to the government. True. RBI holds government securities on its books, probably True. About closer to 7 lakh crores right now. True. So the money is not as if it's been held back within RBI, it's already been lent to the government. True. Now if you extract that money, you're doing 2 things. You're borrowing against that money, and you're taking the money as well. That's simply printing money. That's simply, monetization of the deficit.
The RBI's stance on many of these issues is something that I'm very sympathetic towards, because in fact, the government should be using the RBI as a bulwark to allow the case for longer term priorities to dominate the shorter term concerns. So the government can actually finesse its own reactions to its own constituencies using the RBI as a shield. So there I have no problems with the RBI stance, especially on the reserves and on the prompt corrective action, etc.
To start consultation, a letter under Section 7 is not required. Why don't they go ahead and consult? I remember that in our time, I used to fly across to Bombay to consult with the Reserve Bank Governor. Mr. Bimal Jalan was there at that time. On any issues which the finance minister or the prime minister found it important. So it is not necessary that I will call them over, they must sit across the table, they must come to me. I mean, I don't understand this kind of, for me, I don't understand this kind of approach at all.
We have been in India for decades. So for us, one of the reasons why we thought India was a really good emerging market to invest in was because of the solidity of these institutions. And an attempt over the last few years to go at them, I don't think ends up being very productive for any government in the long run. Today, politically, you may win. Today, you may win a spat here and get your things in better shape from on the TV screens. But at the end of the day, you chip at these institutions from long-term perspective, and for long-term investors, that's a really bad outcome. At the end of the day, that is really the crucial point I was trying to make. Reserve Bank is one pristine institution, has some level of credibility in the marketplace, and if you kind of go at it, that is not going to be productive in the long run.
Well, all eyes out for this meeting. However, there are some other editorial points that we should watch out for as well. The last 2 years have been tough for cement companies. That's the next piece on First Word, by the way. It started with demonetization, followed with RERA, which meant construction activity suffered, and then GST disrupted the supply chain. But things may be turning around now, with almost all cement players reporting better capacity utilization in the quarter gone by, which is typically a weak quarter. So why has this happened, and what would this indicate, if anything? Nikki Mirchandani is here to put this into context. Morning, Nikki.
Hi, Neeraj. I'm going to start off with the utilization levels because clearly things have started looking up for cement industries after 2 tough years. If you look at the growth that we have in the last 5 quarters across the companies that we've seen, you will see a clear trend emerging out of this. In Q4 FY18, you saw the utilization levels on an average being around that 60-65% kind of level. And if you move that to the one that we've recently noticed, you would see a utilization level which comes out to a 70-75% kind of level. So clearly we're looking at a trend which is emerging out. But if you look at these numbers somewhere in between of Q3, Q4 quarter, you would see some patchy levels number coming in, but then a clear trend emerges out if you see it from the year-on-year basis. Ultratech numbers, however, if you look at the utilization levels overall, you would see a dip right now on account of the inclusion of JPA assets. X that, you would see a high utilization levels. In fact, Ultratech has also given a very bullish, has painted a very bullish scenario coming in for the industry. It says that FY19, as per the November presentation, it has given a utilization rate of a 69% overall for cement industry, which is the highest that we have seen last since FY12, when the numbers were, more than a 69% kind of level, a 72% kind of level. So we're looking at that 70-75% level as per the industry leader, and on back of that, anticipating good demand, we have seen importantly 3 companies around the September quarter announcing their expansion plans. Let's have a look at them. First, we're going to be talking about India Cement, which has announced a 2.3 MTPA plan for which is going to be commenced by the second half of the financial year. It also has a grinding unit of 1.5 MTPA, which is going to be kicking in the second half of FY21. We also have Shree Cement, which has major presence coming in from the northern region, and that company is going to be expanding the capacity by 5.5 MTPA, clearly the fastest expansion which is going to be coming on board in the first half of FY20. And last in the list, we also have one more company, which is going to be Oriole Cement, which is going to be 2.6 MTPA expansion coming in. But then do bear in mind the fact that the expansion kicks in at a really later stage as compared to India Cement and Shree Cement, probably a 3-year expansion process. End of FY21, end of FY20 and 23 is the 3-year envisioned. And if you look at these companies, these are south and north based companies essentially which have expanded, which have announced their expansion plans, and these are also the companies which have reported higher utilization numbers. Now if you look at the revenue growth, we're estimating a better revenue growth coming in from the northern and the southern companies. We're looking at India Cement, Shree Cement and Dalmia Group, which previously had announced a higher utilization or a higher expansion plan. So on back of the development on the high utilization levels and the expansion plans, we're looking at higher revenue growth estimates of FY20 as compared to the one that we've seen in FY18. On the flip side, we have ECC, Ultratech, Oriole Cement and JK Lakshmi Cement. But then do bear in mind, Oriole Cement now has made it to the list despite announcing the expansion plans, because much of it gets kicked in only after FY21, whereas Ultratech has already gone for expansion. ECC is has not announced any expansion plans, and JK Lakshmi has also been pretty much muted in terms of the expansion announcement plans for at least next 12 months.
Okay, thanks Nikki. Thanks for putting that into perspective. The moot point out here, cement companies are announcing expansion plans and the capacity utilization levels are moving up. Is that a sign of volume growth coming back in a meaningful way, or does corporate India within the cement space believe that? Well, let's wait and watch. The next piece, and that's on the liquor companies. Now, Indians are letting their hair down and partying more. At least that's what the growth reported by those liquor manufacturers in the first half of this financial year suggests. However, it is the larger players that are getting larger, while the smaller ones are struggling. Agam Vakil joins us to compare and contrast these numbers. Agam, good morning. What did you observe in these numbers?
Well, good morning, Neeraj. I was having this conversation with you the other day, and as a lot of these HNIs were suggesting that the size is becoming an advantage when it comes to the liquor market, and that's kind kind of the trend that's playing out from the study that I've made. So if you consider the last couple of quarters, that is the first half of this financial year. Let's start off with the growth rates. And as you can see on your screen, it is essentially United Spirits and United Breweries, which are the largest companies by far in the listed space out here, are seeing that consistent 14% growth coming through. Radico Khaitan has had a particularly good year because of several changes on the kind of market share that they've gained through the course of the week, and that's the reason why you're seeing that 20% growth there. In comparison, GM Breweries, Som Distilleries and Global Spirits, the growth has not been as good. And do remember, I have only taken companies with the market capitalization of over 200 crores for the study, and also Pioneer Distilleries in this case has not been considered, considering it is a subsidiary of United Spirits. But that said, let's move on to some of these factors which are actually impacting the way we've seen liquor companies move around. So we do know that the companies, a lot of these companies are focused on premiumization. They've renovated their brands. We've also seen hikes in the previous financial year, which is coming to aid when it comes to growth, and of course market share, essentially for the likes of McDowell's and perhaps Signature and something like an Antiquity relaunch, and that's something which is extending brand equity for United Spirits essentially. That said, let's move on and talk about your margins and of course, while we have, okay, so coming down to your market share gains, we have seen exceptional market share, and as I was mentioning, it is essentially McDowell's which is pushing market share for United Spirits. Once again, it's Radico Khaitan which is enjoying 25% market share in rum, 8% in vodka. And do remember, a lot of these are in different states, so it will be a little mixed when it comes to the market share. But Radico Khaitan, as I was mentioning, essentially is the reason why we've seen 20% growth and is leading the growth in this top, your top half of that table. Som Distilleries and Global Spirits, on the other hand, are two companies which are seeing a lot of operational problems. While Som did start off very, very strong earlier in, well, perhaps the previous half of the year, the last couple of quarters have not turned out as per expectations. But this is also because of some operational pangs that have impacted Som Distilleries. But that said, I want to address what's going on in your margins as well. What's standing out in margins is once again your curtail input costs, but we know the considerable advantage that has come on the back of ethanol prices, and that's the reason why you've seen considerable expansion in not just your larger companies, but also companies which have, well, a relatively smaller market share. Finally, coming down to valuations, and well, I want to address valuations because this is going to be showing you the exact picture. You see the likes of something like a United Spirits or United Breweries trading at 77 times, 88 times. This is, of course, trailing PE. Radico Khaitan coming next at 47 times. Do remember, these are companies with the highest market capitalization. On the other hand, despite the fact that we've seen good growth in GM Breweries, well, GM Breweries, Som Distilleries, Global Spirits still trading at a significant discount to something like a United Spirits. Of course, Global Spirits is an exception here because of profitability issues, and that's the reason why it's been trading at high levels. But on the whole, Neeraj, the conclusion that I may draw with what we've seen through the course of these last two quarters is that the larger companies certainly have had more of an advantage as compared to the smaller companies.
Yeah, maybe in operations and maybe in market share as well. Agam, thanks for putting that into perspective. Appreciate that. So do watch out, and people seem to be preferring the larger liquor companies as opposed to the smaller ones. In fact, the purchases that have all happened in United Spirits, United Breweries and Radico Khaitan from HNI investors compared to the other ones. Okay, the last but not the least, and that's a piece on Page Industries. Now, the stock has fallen quite a bit in the recent past. There's no stopping this company because analysts couldn't get enough of it. At least that's what the recent past suggested, despite the very expensive valuations. But the tide has turned in the second quarter when growth slowed after 9 strong quarters. Now, here's the small thing on what I think has happened in Page Industries. One, the deceleration in earnings growth in Q2 after 9 strong quarters, as we said. So that was the first piece that I think hit Page Industries. The overall volume growth in this quarter was the lowest in the last 25 quarters. This is a chart that I've borrowed from the Motilal Oswal brokerage note, and it shows how the volume growth, overall volume growth, was flat. And this has never happened in at least the last 25 quarters, if not more. While the part reason for the soft Q2 timing was the timing mismatch of the festive season, and the management does believe, or analysts do believe, that volumes will be back on track from the third quarter of FY19. The question mark remains whether it can bounce back and bring the overall average volume growth to 10-11% or no. Now, the key statistics for Page. Remember, from the annual report, we'd spoken about this in the past, that the total number of pieces that Page Industries sold, innerwear, womenwear, all combined, was about 18 crores in FY19. One would have expected that we would have seen some growth in the first half, but no, the first half has just been about 9.1 crore pieces, and therefore the question mark remains that while it still effectively caters to only less than 3% of the population, assuming that a customer on average would buy about 5 or 6 jockey garments a year, the question mark only is that can Page Industries move up from this 9 crores a half or 18 crores a year to the next level very, very soon, or will it take some time? And the way ahead on the valuation front, and this is something that I drew down from the kind of prices that Page Industries has traded over the last few months. It's trading currently at 52 times FY20 EPS versus 62 times 10 days ago, and the peak valuation was about 72 times FY20 EPS. All of this is FY20, by the way. The peak valuation on August 28, when the stock price was somewhere around 35,000 odd, was 72 times. In a period of 3 months or 4 months, Page Industries valuations have come down from 72 times to 52 times. However, it is still not cheap, and it is very important to estimate the length of the run of the 20% plus earnings growth that Page Industries can bring, because that is the aspect on which the valuation multiples of Page Industries would behave. Will the multiple stay at about northwards of 50 times, or will they dip further? Would essentially depend on what the management or what the company is able to do in quarter 3 and quarter 4, and their commentary about how long do they believe these growth numbers would last. I will frankly be watching out for 2 or 3 names, 2 or 3 things from the Page Industries stable. One, whether the inventory days decline from the current 81 days or the 81 days that they reported in FY18. Whether the quantum of outsourcing in the second half will move up. It is currently at about 28 to 29% and very, very flattish. And whether they have the ability to hike prices in the December to the January period to offset the increase in yarn costs. Remember, last time they didn't increase the prices too much. Do they have the ability to be able to hike prices and pass them on to the consumer to offset the increase in yarn costs? I think that will be important. And of course, watch out for the outsourcing percentages. They were, I already spoke about it. From less than 20% in FY17 to about 28-29%. Can it move up further, and can that aid margins? So all of that to monitor. But I think the most important slide to my mind was how the valuations for even a strong company like Page have come down from 72 times to about 52 times. Can it revive, or can it stay stable at the current levels? That's the key thing. Let's wait and watch. That brings us to the end of First Word, but a lot more lined up on Indian We discuss markets and macros with Bhat of Dalton Capital Advisors. Discuss the past struggle between India's monetary policy makers and government officials over RBI's capital framework with Indira Rajaraman, who was the former member of the RBI Central Board. And as India's largest media company makes its attempt to become technologically resilient, we take a look at the dynamics at play with an industry veteran, Ronnie Screwvala, joins in to speak about Z. But after this break, a full tilt towards the day's trade.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
Hello and welcome. You're still watching Indian Open right here on Bloomberg Quint. A quick look at Asia and how we're faring this morning. Seems to be slightly more bright and positive for the Asian indices. Nikkei 225 up about 1/3%. Shanghai trading slightly flat along with the Hang Seng as well. For SGX Nifty, the move is slightly more pronounced, so about 0.5% gains coming in there, taking it past that 10,700 mark. For our markets as well, last week was nonetheless an exciting week. Gains of closer to about more than 0.5% on the benchmark indices, following through the third straight week of gains that came in. We're also probably looking at the way the opening has been on SGX and going to make a dash towards 10,700. But how are the options activity and the futures activity suggestive? Let's take a look and go across to Agam, who's joining in right now. Agam, good morning.
Good morning, Devina. Well, what we saw last Friday was a little bit of an increase in open interest when it comes to the Nifty futures. Do remember, we did see an advance of around 0.6% there. So some longs building in there. On the other hand, the Nifty Banking Index saw unwinding, considering a 2.5% decline in open interest. But there was, on the whole, very little move when it comes to OI in both the futures. The India VIX did come off to a certain extent, but it still moves within a range of 18 and 19. So it is still heady when it comes to your option premiums. And speaking of options, we do have maximum open interest currently remain with the 10,200 put, and on the higher end it is the 10,800 call. So it is essentially a 600-point range within which we're expecting the Nifty to move within in the near term. Well, when it comes to changes in OI, it was 10,600 once again, which was in focus considering the unwinding that we saw in that specific call and writing in the 10,600 put. But moving on, when it comes to your put call ratio, well, the Nifty as well as the Nifty banking put call ratios edged up higher. For the Nifty, it's at 1.64, the Bank Nifty at around 1.26. Moving on, we do have Jet Airways, which has moved out of the band, so watch out for this one. On the other hand, Adani Enterprises moves into the F&O band. So with that, we're also keeping an eye on Ajanta Pharma, which has seen fresh longs. Tata LC, on the other hand, has seen fresh shorts, and it continues to grind lower. And Canara Bank is the other one, which has also seen some longs moving up in tandem with a whole host of other Nifty PSU banking stocks. So we'll be watching out for some of these names as we move into trade today.
Right. Agam, thanks very much for that. It's interesting, Neeraj, the FPI numbers also are very encouraging so far. While in the month of October, we did see a pullout of about 38,900 crores overall. This time around, from 1st November to 16th November, we've already seen inflows of about 8,200 crores. From that 3,800 into the equity markets and the remainder of that in the debt market. So
indicative signs are not looking all that bad. Interest is building back again into the system. We're making our approach towards 10,700. Whether or not this culminates into something bigger has to be we have to wait and watch out for that, because there are a lot of things that we need to keep an eye out on, and not just the RBI board meeting today and what comes out of there, but just the overall market sentiment globally, what's been happening as well.
Yeah, I mean, so globally markets have remained circumspect, but we've done rather well. The last week returns testimony to that. Nifty up about 0.9%, Dow, S&P, Nikkei, all of them correcting. So we've done reasonably well. Let's just see if today is a watershed moment for Reserve Bank of India or no. And one hopes that nothing untoward happens there. And the merry run may well continue. 10,750 for our markets as we speak. The S6 Nifty is indicating that.
Yeah, so strong start thereof. Let's see whether that percolates down to our markets as well when we open up for trade this morning. But Samir Kalra is joining in right now to take us through his views. Samir, last 3 weeks, week-on-week positive close, and it's been really encouraging. What's your sense?
So I think it's a pullback. Today, the RBI board meet might extend that pullback if everything comes out much more smoothly than expected. So that pullback might take you to around 11,000. Another state elections might bring you closer to that. So I think it's an opportunity for people who were able to exit certain stocks in the last upside. So they can relook at their portfolios and see where they can create cash for another downside, because I think that will come in a month or 2 months. So I think that kind of a cash creation can happen, what they weren't able to do on the 11,700. They can do in this pullback. I don't recommend any going aggressive buying for a longer view right now, because you might see a lower levels at uncertain times or ahead of the general election. So I think the more the pullback comes out, the better it is for a person to create the cash out of the portfolio and look for the stocks when the downtime comes and start investing over there in heavily.
Interesting. Let's talk about some of these, Samir, some of the stocks. Bhatia, to my mind, was one interesting mover. In Friday's session, up about 9% there. The analyst meet, it actually propelled even Vodafone Idea along with itself. I was looking at the commentary that the management has given post the meet as well. They believe ARPUs have mostly bottomed out relative to the market prices. They believe there's an opportunity to increase market share, all of that. Does all of this lead you to believe that there might be substance in owning a telco, and Bhatia Airtel in particular?
So we own a slight bit of Vodafone Idea at a very low levels like 39, 40. We're not afraid of that because the weightage is very low. We believe that will come in the system of...
No, but why Vodafone Idea and why not Bharti?
See, Bharti has a lot of currency issues as well. If you see the Africa, we liked Bharti before the Africa deal happened. And after that had happened, we really didn't like Bharti because it went too aggressive in expansion of the international operations. Now when it's winding down, its focus is more on the winding down of that business. And Vodafone Idea, see, we believe that when you have a MNC pocket now, the equity raising is around 25,000 now. They have the Indus Towers stakes to be sold off. So the leverage will happen much more quicker on that end. Bharti might have another point of leveraging, which is happening, that 1.5 which if they raised. But I think over there, the pressure from the unexpected player, the Vodafone Idea, which everyone's discounting right now, the upside can be bigger in the sense when the ARPU change around, because they have taken a bigger hit in all this rather than the Bharti Airtel. So I think the bigger hit taken on a company's numbers, the more sustainability they'll show when it turns upside. So, and see, the only point is that talk of bottoming out of ARPU happened 6 months prior also. When 1 year anniversary of Jio happened, that time also this talk happened. But it didn't materialistically happen on the ground.
Sure.
So we are waiting for Reliance to pick up the pricing, and then only we'll believe the ARPU has bottomed out.
One question before we go across to our huddle is on Yes Bank. Bad week. Last 2 days particularly, stock have been really thrashed. Now ICRA coming out and putting its long-term rating on a watch, possibility of a downgrade there. What's your sense?
So our sense is a bit contrary on the stock. We've already bought it at 190 kind of levels, these levels only. previous to all these kind of news. And we've been constantly buying in the smaller bits whenever these kind of reactions come in. So the resignation, one of the OP part resignations created much more panic from the select committee. But if you see the 10 shortlisted, there are kind of a conflict of interest over there. So one is the CEO of Standard Chartered who has come out, and OP Bhat is already the board member of Standard Chartered. So that cannot happen, and he had to resign because of that. But it took it in a negative way because the sentiment is negative right now for Yes Bank. So I think we capitalize on that and we still buying. If you see the rating part is more sentimental negative. They've kept it under watch because they see these resignations and the numbers getting into a negative zone.
Yeah.
But I think once the whole December end or by January 1st week when the announcement kicks in for the new MD, I think everyone will be a change of sentiments will happen, and I think the positivity will come in maybe a next 9 months. So whenever we enter a stock, we are ready to buy it even at a 40% downside from where we started buying.
Right.
So I think I'm very comfortable in creating that kind of a situation for the stock.
Okay, got that. So buying into Yes Bank right now. So we just stay on with us. We go across to our research team. They are all here with us to run us through, some stocks and news and some more results. Particularly talk about Siemens and the strong numbers that they posted. Darshan, Nikki, both of them here with us. Nikki, I'll start off with you on some stocks and news first.
I'm going to start off with Jet Airways in that case. Tata Sun has clarified on a Friday that it's just at preliminary stages of discussion with Jet Airways. No formal proposal, however, has been made. Separately, Jet Airways has a development where 10 of its flights were cancelled in Mumbai and flyers were stranded. This is a PTI report that we're talking about. Second in the list, we are talking Yes Bank, where ICRA has placed, as we've just discussed some time back, the bank under the long-term rating of the bank has been kept under the rating watch with negative implications. And the rating agency also believes that the bank's ability to raise capital may be constrained in the near term. Dr. Reddy's lab, which has received a zero observation coming in for the formulation plant in Andhra Pradesh from US FDA, a positive development for that company. We are also tracking in bunch of buyback, right issue and open offer. For buyback, we have Tata Investment Corp, which the board has approved a buyback of equity of more than 8% at a price of around 1,000 per share, which indicates a premium of over 20% from the market price that we saw on a Friday. Shalimar Paints, where the board has proposed a right issue of 3.4 crore shares at a price of 64 per share, indicating a discount of more than 29% from the Friday market price. And LKP Finance, where they acquired a reduction, Mercantile has announced an open offer to acquire 26% stake in the company at a price of 198 per share, which is pretty much in line with the market price we saw on a Friday. Now remember the fact that the stock already took a hit of more than 6% on a Friday. Also, we're tracking in Nestle, which has been pitted against now Unilever, and in its final round of negotiation for GlaxoSmithKline consumer nutrition business and ET exclusive. Also, we're tracking in Raymond, which has said that where there is a development where global as well as Indian investors are eyeing the land parcel, which includes the lives of Phoenix Mills, Prestige Estate, and also Purvankara projects. In bulk deals, a small company out there, Vikas Ecotech, with a market capitalization of less than 500 crore, where the promoter, Vikas Garg, has sold in more than 4% stake in the company.
Got that, Nikki. Thanks very much for that. Two numbers, Siemens extremely strong, and the other one was Seychelles paper.
Yeah, so I think the trend continues among strong numbers among capital good companies. Siemens, actually, if you're looking at it, is the highest revenue number that they have posted in the past 26 quarters. So it's been a while, and even if as far as the EBITDA margin is concerned, it's a beat of 600 basis points. So it's an extremely strong set of numbers. Now, coming to the bottom line, there was a dip of 55%, but remember, this is on account of an exceptional gain that they had last year, in which they sold land worth 560 crores. So that is something. Because of that, if you adjust that, the revenue growth on an adjusted basis is up almost 39%. So it's a strong growth that Siemens has posted. Mainly higher other income is there that boosted profit. Tax rate is slightly lower this time around, but the order inflow is good. They've grown by 38%, which gives them visibility into FY19. Remember, it's the fourth quarter for Siemens this time around. Across the segment, segmental growth across, so they've done strong performance, but margin wise, there have been contractions in a few of the segment, but overall there's nothing to complain. So most of the analysts that have come out with reports have given it a thumbs up, indicating any potential 30 to 40% upside from the current market price on Siemens stock. The second one is Seshashahi paper, in which sales were up 46%, EBITDA was up almost 70%, and profit up 92%. So margins coming in close to 25%, and this is a trend that we've seen right from when ITC reported its number in the paper division, right across to International Paper and the other companies that reported paper numbers. All of them have reported strong set of numbers. So paper, Seshashahi paper and Siemens both should react positively to the numbers today.
Interesting. Thanks a lot for that, Darshan. Samir, let's talk about some of these paper companies. West Coast Paper, International Paper, now Seshashahi paper. We've seen a lot of interest building up within these stocks, most of them up closer to 50% on a year-on-year basis or even more. So would you say that this is probably likely to continue for these names, and where exactly are you seeing the key triggers?
So I think if you see the paper prices, that increased by 60 to 70% on a YOY basis. So that has given them a good bump up on the margins as well. If you see their balance sheets, they are very stressed because it's another commodity, and the downside commodity cycles impact their working capital. So I think maybe another 2-3 quarters, if the results keep sustainable, I think the prices will move higher of these stocks. But to take a longer term view, I think right now it's not the place to be more than a year kind of view coming in the paper industry, because it's a very heavy debt kind of working capital, and the sales and these margins does not convert into that cash as much as cash and reduce the debts over there, which investor would like to. And I would like to take it as a short-term bet rather than a long-term view on it.
Yeah, but the paper to give credit where it's due, I think some of the paper companies have done really well for themselves in the quarter gone by. Let's wait and watch. That's Samir Kalra's view on what to do with some of these. We'll also take Samir's view on Siemens in moments from now, but it's 8:45. So also should talk a bit about the technicals of the market. Brijesh Bhatia, head of research at Dealmoney Securities, with us on the show, as well as Ruchit Jain, technical analyst at Angel Broking. Gentlemen, both of you, good morning. Thanks for joining in. Brijesh, let's start off with you today. How are you approaching trade? We'll start off likely to start off about 0.5% higher. Would you trim your long positions, or would you stay long ahead of the RBI meet?
I think I would slightly wait for a Nifty to close about 10,750, 760 zone, because it is a gap and might act as a strong resistance zone. Better I would look for with the RBI coming, I think I could look for a long on Bank Nifty because it is given a strong momentum about 26,000 as well now, and last weekly expiry about 26,000 indicates that the short spin which were being aggressively written about 26,000 has been covered now. I think at 26,245 Friday's close on spot, I think one should look for a long opportunity at open as well, and I think another 400 points, 26,630 is the levels target I am eyeing on the upside on Bank Nifty spot with the stop loss of around 26,078.
Okay, so do watch out for the Nifty Bank. And of course, that's been the stronger index last week as well, up about a couple of percentage points. Ruchit Jain, good morning. How are you approaching trade today? Again, a similar question. Whether you would take some money off the table ahead of the RBI board meet today, or would you be comfortable staying long?
It's very good morning, Neeraj. Neeraj, 10,750, 10,800 is the range that we had spoken about even last week. Now there are cluster of resistances in this range. One is the 200-day moving average, which is usually considered as a long-term support or resistance. Since we were trading comfortably below that 200-day moving average on pullback move, that could act as a resistance. Secondly, 89 EMA, which is considered as a medium-term support or resistance, that lies in this range of 10,750 to 800. Third thing is the gap area. On 4th of October, we had seen a gap down opening in Nifty, wherein Nifty corrected about 250-300 points in a single trading session. So that gap is another resistance, which coincides in the same range of 10,750 to 10,800. So I think it's a good time that in this range of 10,750 to 10,800, one should look to book profits on existing long positions. We have already seen an up move of about 700 points in Nifty from the lower levels post the last expiry which we had seen. So So I think it's wise if anyone is having long positions in Nifty and is in a good profits, look to book profits at current levels in the range of 10,750 to 10,800. And there are good stock-specific opportunities over here. So even if the index consolidate around this resistance for few trading sessions, I think stocks would provide better trading opportunities. So we are advising our clients to book profits on long positions in Nifty in the range of 10,750 to 10,100 and trade more on our stock-specific strategies.
Okay, so let's talk about those stock-specific strategies. And I'll start off with you, Ruchit, on what stocks you're recommending this Monday morning.
Apollo Hospitals is my first pick that we have been recommending. During last week, the stock has given a breakout from a consolidation phase on the weekly chart. And the breakout has been supported by very high volumes. You see Thursday's trading session, we had seen a 9 to 10% up move in the stock prices with very high volumes. Friday, some retracement pullback was seen. So I think this is a good buying opportunity. The risk reward ratio is also favorable. Irrespective of market move, I think next 3-4 trading sessions itself, we could see another 8 to 10% up move in Apollo Hospitals. So go long on Apollo Hospitals, keeping stop below 1175, expecting target around 1330. And Sun TV is another stock where we are expecting a pullback move. If I see the weekly charts, then last 5-6 weeks, the stock has been in a consolidation phase, but this entire consolidation phase has panned out above its weekly 200 moving average. So a pullback move could be seen in Friday's trading session. We had seen initial signs of an up move because in last hour of a trade, some good volumes were seen. So go long on Sun TV with stop below 584, expecting target around 655. And both are very short-term trades from 1 week point of view.
Okay, got that. Brijesh, on to your ideas then. You've got a call on Tata Global as well as a Group Finance. Why are you liking these two?
First, Tata Global, because if you look at the momentum, it was quite strongly holding the sub 200 levels now. And if I look at the momentum last week, it has given a good closing on a weekly basis. And if I look at the short-term chart, we are witnessing a strong range breakout on the Tata Global as well. And if I look at the oscillators, they are also trending on a good positive upside. Even daily volume is slow and steady picking up. The volume in the fall was slightly lower, and if you look at the momentum now, the volumes are slightly picking up. So I think purely from a trading point of view of 1 to 2 or 2 to 3 days, I think at 221, 222 is a good buy for the target of around 230, 235, which is around 5 to 7%, and one should place a stop loss of around 216. Group Finance, why Group Finance? Because if you look at the Group Finance, it has been slightly consolidating about 200 as average. And if I look at the last week volume, was very, very strong at around 6 months high. And stocks moving about 200 average, which is generally a strong psychological or a support resistance zone. With strong volumes, stock picking up, I think strong accumulation is happening in this stock. And at around 306, 307, one should look for a target of around 332 on the upside for 1 week, and stop loss would be around 295.
Okay. So those are some important stocks to monitor. I want to talk about 2 or 3 names that came out. Devina spoke about Seshashahi paper and the whole paper stack, which came out with very strong set of numbers with Samir. The other one that came out with very strong numbers was Siemens. Now the stock has had a bit of a run up, but that notwithstanding, the strongest revenue growth in the last number of quarters. Their delivery seemed okay, margins better than estimates. Is this a cue for somebody to go out and invest fresh money in Siemens?
So I think yes, this might be the point where you start watching capital goods much more seriously with a higher weightage in your portfolio. But I would wait for the December quarter, because if you see the numbers and if you see the execution, that has been around a 28% quarter-on-quarter growth for the revenue side. If you see on the EBIT and segmentally divide the EBIT, the main EBIT movement has come from mobility and the process industries. So they are smaller on the revenue for Siemens, but higher on the margins now this quarter. If they are sustainable next quarter as well, I think then there's a transitional change in the business on the EBIT side and the margin side. So if that happens, then the sustainability of these margins and the uptrend is much more higher. Because see, when the order execution comes, it's eventually your clients are giving you the okay to execute the order. That's what's happening now in capital goods. Because earlier the orders were coming in and they were piling on the books. And the execution was slowing down because, the eventual clients were holding off the execution. So I think now there's a movement of execution from the client side, that they are giving you the okay to execute the orders. So I think if it sustains for next quarter as well and shows a quarter-on-quarter growth, I think then there's a change in the whole segment as well. Even if you see L&T, that has happened.
Yeah.
So quarter-on-quarter growths are much more important for the execution levels to come into the books.
But I don't know how you, I don't know how you think about it, but Sameer's answer is probably 2 points to it. One is in a space like capital goods, which hasn't delivered for such a long time. Do you wait for the print to come for a couple of quarters?
Or you miss the bus in the pricing?
Or you believe that even if the valuations are cheaper right now and let the print come, even then if you buy it, then the runway is long enough for you to still make money. So do you wait for that confirmation for the next quarter or a couple of quarters? And maybe that's a safer way to play because you don't know if this will last or not. So a tricky situation. I know the eager money would want to get out because they would believe that, okay, this suggests a trend. But maybe there's merit in waiting as well.
Like L&T, it's not been that much of a drag anyways. So, I mean, while, and in fact, you've just seen the counter hold its ground or probably now see that move starting to kick in on the upside. So, my point being, do you miss the bus on the price?
See, that's what we do. So, we don't miss the bus. You have a portfolio, there's a percentage weightage. So, on this number, you can, start buying it and keep a low weightage on it. So that even on the next print, if it doesn't come and you see a downfall on the number, because see, from here to next print, you have couple of months. And I don't see any negativity coming into that sector for a while, for these 2 months. So you can start buying in the smaller bits. Maybe the next print, if you get the approved kind of a stamp that, this change has kicked in and the quarter-on-quarter improvements are there, then you can add the weight. So you're kind of averaging on the upside rather than missing what you're talking about, missing the bus and the longer version. Because if you buy if you buy Siemens today, it'll any which way open on the upside.
Yeah.
So you might rather want to buy at maybe when this sentiment of results get out. Before the next results, buy a smaller bit, then get the approval of that next results and then add on to it. Or get out if the print is bad.
But it's showing, right? 12% for Siemens, and essentially the last 2 days 10-odd%. L&T the last 1 month about 16-odd%. So some of these names have certainly revved up in the last few days. Sorry?
No, L&T is approaching $100 away from its buyback as well.
Yeah. Okay. So that's the other point to monitor for Larsen & Toubro. So that's one. The other one that remains in focus today is Jet Airways. Now, the market has given a bit of a thumbs up on the anticipation that a deal would happen. Tata's statement didn't give any kind of clarity, but for the fact that it is under consideration. But that's something that everybody knew. The question mark only is, does one go out and look at Jet Airways now? Or if you had bought Jet Airways as a trading play on the back of what's happened on Friday, would you take some money off the table, even if the stock were to start slightly lower?
I think I'll take out most of the money now. If I was
off the table?
Yeah, off the table. If I was trading it.
Which means you are not going to buy it at all?
See, the only point is now if you've put in a trade and you were making money or you are making money as of today. So I think it's better to take out most of the money out of it, because the only point is now when that extended kind of a upside and these kind of speculations are put to rest from the Tata side. Jet Airways was already doing it for a couple of weeks and no one was listening to it. So I think from the Tata side, when it comes, it will put some kind of a negative impact on Jet. And any which way, the materialistic point is, even if they give the approval, it might reach 400. But the only point is now the downside is much more higher, because it comes out of even the futures and options ban. And so that kind of a short creation wasn't there when the news was kicking in. So I think it's better to take off most of the money, keep some if you have the lower prices. If it comes back and you feel again that positive announcement will come in eventually, then you can buy in.
All right. Ruchit, Jet Airways in the charts after 1 month of almost gaining 50%.
I think we had already seen very sharp correction in this calendar year, and usually whenever the corrections are such sharp, the pullback rally are equally sharp as well. So I think this up move which we have seen in last 2-3 weeks, this should be seen just as a pullback move within a downtrend. I don't see any signs that the stock making higher top higher bottom structure on the daily as well as the weekly charts. So I think it's wise to book profits on long positions if anyone is having, and in case if the earlier longs are also there and who are stuck at higher levels, they should also look to exit on this pullback move.
A quick call on L&T, Brijesh.
I think I would continue to stay long on L&T. I think another 80-100 rupees upside can be seen on the stock. So I think the stock is slow and steady, gaining strong momentum as well, and generally it has a tendency of rally, consolidation and rally. And the same thing is happening. We have seen a strong rally from around sub 1300 to 1400 levels. Now stock is slightly consolidating, but I would rather look for a long opportunity still on L&T, and we have seen strong breakouts from multi highs at around 1400 levels. So I think one should remain long on L&T as well.
All right, on L&T there at 1400, 42 seconds left to go for market pre-open to kick in. You're going to watch out for the currency as well. Closing was 71.92, went below that in intraday trade on Friday session, closed slightly weaker, but nonetheless below the fine print of 72. So we're going to watch out for that, considering the global market cues are supportive. The SGX Nifty pointing towards a stronger start. I should just pull up the SGX Nifty as well as the other Asian markets as well. So an improvement there for Shanghai and Hang Seng, which was flat, now gaining about a third of a percent apiece, and Nikkei 225 also in the same boat. SGX Nifty 10,748, so just about 50 odd points higher. And that's the pre-open session for you on your screens, 10,700 at first stick. So not bad, but these are not the final prices yet again. 35,584 on Sensex. Watch out closely for individual stocks and the moves thereabout. Dr. Reddy's is kicking open today's session with 10% gains that will consolidate. Z is up about 3.9%, and Pharma is up 3.5%. Reliance Industries, again, that stock has seen some bout of buying coming back into the counter. It's moving towards the 1200 mark yet again. Asian Paints 1.3% higher. Infosys is up as well, 1.3%. Interesting to see moves on Coal India, which is up 1%. Tata Steel, Cipla, Maruti Suzuki are all gainers in trade today. Amongst the losers, Axis Bank, Bharti Airtel, Tata Motors, Bajaj Auto, HPCL. So a handful of about 8 stocks are in the red right now. Not much is happening there. Indiabulls Housing Finance, so bled out about 5% in Friday's session. Today, carrying forward some of those losses in pre-open, at least down about 1% at 758.
Bring up Jet Airways and see what that is doing in the session today. Should pull that stock slam dunk right now. Let's wait and watch whether it opens up as low or there is not going to be so much pain in Jet Airways. Glenmark Pharma looks like starting on fire. There is, I think, a Morgan Stanley note as well, which speaks about this, by the way. We'll be hearing from management tomorrow, so keep that at the back of your mind. Rein Industries, after having a 9% downtick in Friday's session, starts off another 10% lower. By the way, this is a stock that we'll discuss. 3 days on a trot now, it's been lower after what was arguably a very poor quarter. So Rein Industries, do watch out for that one as well. There is Siemens that we should try and pull up and see what that stock is doing in the session today. After 10% uptick in the last 2 days, last week, another 2% at the start. Let's see if this lasts or no, of course. That's the other one. So do monitor this one too. And last but not the least, along with Jet Airways, I think Interglobe Aviation and SpiceJet are the other two that we should pull up, because they had started off rallying along with Jet. Promptly looks like Indigo too could start off lower. Let's pull up SpiceJet. That too could start off lower in trade. So let's wait and watch what happens. Infibeam, after the 10% downtake, looks like we'll start off on the 5% lower. I'm sure Devina probably would have marked the currency, but if not, let me just quickly mark what's happening to the macros. The currency and the bond yields will come up on your screen. 71.99, flattish from 9.3 to 9.9, so hardly any move there. The bond yields at 7.76, if I'm not wrong, 7.82. A bit of hardening of the bond yields as well, so the bond prices have come off, and that's led to the hardening of the yields as well. Okay, before we move back to our guests, Darshan Mehta is standing by with the top brokerage calls of the morning. Darshan, what's standing out?
Yeah, so there are three calls that are there. First of all, it's the Deutsche Bank report on the tyre companies. They remain positive on all the three tyre companies. They're saying that the volume growth is expected to be strong across companies, and any kind of input price pressure would be met by price hike. Apollo Tyres is their top pick, but they remain constructive on both CEAT as well as MRF. So that's the first one. Second one is JP Morgan on NMDC. Now on Friday we came to know about the entire deal with the state government issue versus NMDC in terms of the Donimalai mine. They're saying that this becomes, the renewal now becomes extremely difficult for them. There could be a legal route ahead, and if that is taken, there could be production cuts that could come in, and if the production cut comes in, there will be earnings pressure that will come in. So that's their view. And Citi is bullish on Nestle. They're saying their forecast shows an 8 to 9% volume growth for the next 2 years. They're saying that the cluster strategy is doing extremely well for them, and Nestle is still trading at a discount to the average premium that there is in the sector. So they're bullish on Nestle with a target price of 11,800. All right,
Darshan, thanks a lot for that. Should pull up a Dr. Reddy's to see if the stock has come off. Yes, it has, about 3% from the initial 10%. So zero observations from US FDA for its AP plant, and probably that's another kicker for Dr. Reddy's. Pharma as a pack, Samir?
So we have only one Sun Pharma invested. Over there, if you see all the farmers in past 2 to 3 years, since the US FDA has put up import alerts and all these issues have come in, a lot of pharma balance sheets have stretched. So the cash flow has really gone down. They have raised a lot of debt. So I think the US pricing pressure, until unless it comes out of the system, the cash flow generation will be still lower. Sun Pharma out of them was able to maintain the sustainability of the balance sheet during all these times. So I think I rather go with Sun Pharma than any other name right now. I would like to see the reduction of debt on the balance sheets, because these debts are more working capital led, and these are systematic debts. So they don't reduce with sales, they increase with sales. So I think over that, I would like to keep an eye on them. But yeah, as an investment, I think Sun Pharma is the place.
All right. That's Sun Pharma for you, 525 at pre-open. Indiabulls Housing Finance is the other one. Should pull that stock up to see how it's doing right now. 1% lower. Friday session saw a cut of about 5% on the counter. Not just Indiabulls Housing Finance, Divan Housing Finance, Repco Housing, LIC Housing. So all of these names saw a slight bit of a bleed in Friday's session. Today, some amount of respite there, but marginal gains into all of them. Ruchit, would you do anything in any of these housing finance companies?
I think the trend for both the Indiabulls as well as Divan still continues to remain down. If I just compare the volumes of last 2-3 months, when the prices had corrected in the month of September and October, the volumes on correction were quite high. And when the pullback move has been seen in last 2-3 weeks, in the initial 2 weeks of this month, then the volumes on the pullback moves are quite low. So the stocks are going down with high volumes, and the up moves have been not been supported by any significant volume. So this is clear a negative sign. I think Indiabulls Housing still can be shorted at current levels with stop loss above 795, 796, and we can expect the recent lows of around 670 to be tested again.
Okay, just a couple of other stocks that I want to talk about. Tata Investment looks like starting off well on a lot of message boards. This one is turning out to be a stock that people are talking about buying Tata Investment Corporation. They have approved a buyback at a price of 1,000 rupees per equity share. Samir, have you been able to study this? It's not a stock that usually comes up in the realms of discussion, but because of the buyback active today.
So I think if you take it fundamentally, it's a holding company. So the discounts are still at 30 to 35%. On a usual, it tracks same kind of level of discounts. So valuation wise, I don't see any changes. If you talk about particularly the buyback price, then if you see it's 8% of the total share capital, which is let's say market cap in a certain sense, and 73% is with promoters. So they'll be also participating. So it can be a good opportunity for a person who already has it at lower levels. But I don't think so there's a trade-off to invest and expect that you'll make money out of it. Because eventually it's more of taking out money of the firm and rather than, taking more of a buyback or reduction of the number of shares to increase the EPS. So I think it's more of taking out cash off the books. So I think you rather stay out and don't deal with that kind of a pressure with whether the acceptance ratio will be X or Y.
Okay. 7 days, about 22%, so some bit of pricing in already done, up another 5% at the start of the trading session. Let's wait and watch if that lasts. The pre-open rates have settled, and we are looking like we'll start off about 0.5% on the index. Jet Airways will start off lower, but the index looks like we'll start off well. 10,731. However, this is not above the levels at which our experts would be comfortable buying. So as of now, a bit of a status quo, I presume.
Well, considering that, also watching out for where the call option concentration is right now, it's at 10,800. So that still provides you with a stiff, upside resistance. So whether or not a buy at these levels and then you go up to 10,800 just to come back down gives that favorable risk reward in terms of returns for option buyers. Is something we need to ask our experts and see whether they are in favor of taking such a trade or not.
And maybe because of the RBI board meet today as well, might pay to just stay on the sidelines instead of trying to be a brave heart. Just wondering, Brijesh, on the Nifty or the Nifty Bank, as the pre-open rates have settled, if they start off 0.5% higher, what would your trade be? Or would you rather not do any trade on open?
I would rather go for Bank Nifty long, or I would slightly stay at 10,750, 10,060 stands out to be strong resistance on Nifty. So I would rather look for a Bank Nifty because it's being strong outperforming. And if we look at the HDFC Bank, ICICI Bank, both strongly giving a strong breakouts and moving higher. So I think Bank Nifty, I would look for a long opportunity, or anyone in case want to take a low risk and look for a buying 26,400, 26,500 calls option also. So I would rather look for Bank Nifty long.
Okay, that's reiterated now by Brijesh that he's looking to buy the Nifty Bank as opposed to the Nifty 50 on open. Minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Startup, all eyes on the RBI board meet today. Amongst the several points of the agenda are the transfer of surplus reserves to the government and an easing of the prompt corrective action guidelines.
Among earnings that came over the weekend, Sai Paper and Siemens reported strong quarterly results.
Tata Sons has said in talks to buy a stake in the cash-tapped airline Jet Airways are at a preliminary stage and no proposal has been made as yet.
And Vodafone India has clarified that the company has not considered any proposal to sell fiber assets to Bharti Infratel and that the news is factually incorrect.
In the aftermath of Cyclone Gaja, SRF has said that its Technical textiles unit in Tamil Nadu has been damaged. The company also said that steps are being taken to restore normal operations.
And lastly, in bulk deals, Nomura buys 2.5% stake in Vikas Ecotech, while Aditya Birla Mutual Fund buys 1.25% stake in Tejas Networks.
Well, interesting, and that's about 11 lakh shares being bought by the Aditya Birla IMF in Tejas Networks. They recently got a large order, I think from Sterlite Tech and some other companies as well. So do watch out for Tejas Networks. Might be some fun and games in the times ahead. But Jet Airways looks like starting off 7% lower. That's arguably the top mover at the broader end of the spectrum. Ruchit, you want to come in here? 7% lower, 322. If you had a chance to trade, if you wanted to trade it at open, what would your trade be?
No, Neeraj, if I would just advise that if any existing long positions are there, then they should look to square off even at 7% lower, which we had seen in the pre-opening. But I won't take a fresh trade on the short side because the stop loss won't be that much nearer to what we had seen on Friday's high. But just square off the existing long positions, if any, that would be the advice.
Just, Samir, take one question before we let you go. Tire companies for you right now, considering crude oil has come up significantly, what's your sense whether investment opportunities here make sense?
So for us, Balkrishna Industries was the only one which we like to invest in that because of the balance sheets and the business they do. If you see the domestic ones, their market shares have been static for now decades. It's not a couple of years, it's been decades. And it's a heavy capex cycle which they have to keep on doing to keep the market shares running. And crude cycles are one way or the other. So I think the downside of the crude is over. So the benefits of actual crude down cycle is over for these tire companies. There can be a quarter or two where they benefit out of it. But on the upside of the crude cycles, which will hit in October and November because it's a derivative use they do. So the last upside of the crude will come in this quarter. So I think that kind of effect, we keep it away from ourselves and focus on Balkrishna.
Balakrishna. Okay, got that. Thanks so much, Samir. Really appreciate you taking out the time and being here with us.
Well, about a minute and 50 left for the markets to kickstart trade. Just very quickly, Brijesh, for somebody who took a long position in Bharti in Friday's session, it's likely to start off 1% lower. Would you take some profits off the table, or would you stay long?
I think one should stay long. I am eyeing around 355 to 360 levels on the upside, which is around 200 weekly average. So I think one should hold on. Still another 10% upside can be expected on this stock.
Okay, got that. With just about 1 minute left to go for market opening, let's quickly run through the top trading ideas from our experts. I'll start off with you, Brijesh, your top call.
Top call would be buy on Tata Global at around 220, 122. Target would be 230 to 235 with the stop loss of 216. And Guru Finance, though DHFL eyeballs are on the downside, I still prefer Guru to look for long opportunity towards 332 as a target.
Okay, Ruchit, what about you? Your top call.
I would recommend one of my pick, which was Apollo Hospitals. From an intraday perspective, I will give different levels. One can go long for intraday also with stop below 1200, expecting target of 1285.
Well, Apollo has been at the center stage of a lot of ideas as well. Let's watch out for this one too. Ruchit, Brijesh, Jain, just stay on. We'll just take opening thoughts from you post market open. But 20 seconds left for the markets to kickstart trade. Expect us to start off well. The question mark only is, do we hold on to those levels? The Asian markets are buoyant, so no negative news coming in from our peers. Whether or not the market gets slightly nervous ahead of the RBI board meet, that's the key question. Let's wait and watch. But here's how the markets are starting off this Monday morning, 19th of November. 0.5% higher for almost all of the key benchmark indices. Not a bad start. Let's see how strongly this holds. The mid caps and the small caps should come up on your screen, and let's see if they've started off well. The small caps and the mid caps about 0.25% apiece. So, well, not a bad start, I must say. And we aren't quite slipping. We're still about 0.5% for the Sensex as well. So it's not a bad start for the trading day today. The Nifty Bank though has cooled off a little bit. The Nifty about 1/3% too. But what's moving, what's not? Yes Bank about a couple of percentage points higher, 2.5% higher. Dr. Reddy's reacts fundamentally. Infosys, iShares, Indiabulls Housing Finance, stocks which had taken a drubbing. The Yes Bank, Indiabulls Housing, as well as maybe DHFL could be reacting, but those are the 2 or 3 names that stand out. IT is doing reasonably okay for itself. On the flip side, Bharti, after a 9% uptick, starts off about a couple of percentage points lower. HCL Tech marginally lower, so it's not all green in the IT. Couple of stocks have come off. HCL Tech too, by the way, was about 3.5 or 4% in Friday's trade. But no big moves, as you can see, save for Dr. Reddy's. It's that one newsmaker which is doing well, and Bharti is probably the other one which is starting off lower. So 2 stocks in news doing accordingly. That's on the index. Lots more happening at the broader end of the spectrum. Let me quickly highlight a couple of stocks before I hand it over to Devina for figuring out what's moving around. Some newsmakers, strong results compared to estimates, but a run-up before the results. Maybe that's leading to a bit of profit booking in Siemens, 1% lower in trade today. What about some of the other newsmakers and stocks which are in focus? So Jet Airways, Vodafone Idea, both of the stocks which had a fabulous run the last couple of days, or at least in Friday's session, start off lower. What's had a 6% slam dunk, and you heard the management speak extensively on Bloomberg Quinton Countdown. NMDC starts off marginally stable in trade today. Last but not the least, the top losers or the top gainers, the top movers essentially, the whole of last week and in Friday in particular. Let's see how they're starting off. Rein Industries, another 5% lower, so not the greatest of days. But DHFL, as I said, along with the Yes Bank and Indiabulls Housing Finance, DHFL starts off marginally higher as well. Devina, what are you spotting?
Well, you highlighted some of the names there, and those are amongst the top 6 or 7 losers on the mid cap index. So I'll skip those and I'll go to the next bunch of stocks which are making the moves on the downside. And HCL Infosystems is down about 2.5%. You've got Unitech down 2.2%. Deepak Fertilizers, Bajaj Hindustan down 1.86%. Should pull up the entire sugar space because that has been an active pocket since quite some time now. So Adhampur, Balrampur, all of them looking like they're giving up some bit in today's session. JBF Industries, HDIL are some of the names there that are looking weak. Interglobe Aviation, following suit with what Jet Airways is doing, is down in the session this morning. The likes of Sterlite Tech, that Sadani Transmission are some of the other bigger losers. Tata Elxsi down closer to 1%. IDFC and Shriram Transport Finance are amongst the weaker names this morning. Amongst gainers, Tata Investment is up about 6.5%, 7% rather. And then you have Ratan India Power. Friday session also, the stocks saw double-digit gains. I'm talking about Ratan India Power, closer to about 16-17%. And today as well, the stocks up about 6%. A very small stock, just a 3 rupee stock, but pricing activity has really picked up. Bombay Rayon is up about 5%. 8K miles, very dicey, 40% in the last 7 days, but yet again has piled up 5% gains. Everett Industries, Mahindra Holidays, Syndicate Bank, Indian Hotel, and Oil India are some of the key gainers in today's session.
Well, just quick thoughts from our experts before we get in from a big fundamental voice on the show. Ruchit, Jain, opening thoughts, any stock that stands out for you?
In fact, no, I would just comment on the index itself because we had already spoken about 10,750, 10,800 being a resistance zone. And since opening, we have been seeing that there is no follow-up buying seen post a gap-up opening. Secondly, I would just also highlight about the Nifty Mid Cap Index. During last week, entire 5 trading sessions, the Mid Cap Index had consolidated around its resistance area. And in spite of Thursday, Friday, where we had seen good stock-specific momentum, the Mid Cap Index has not given a breakout. So this is somewhat a concern. 10,750 to 10,800, and so I would advise to, I would in fact recommend to take some money off the table over here.
All right. What about
you, Brijesh?
Yeah, on the stock side, I think one can look for Bank of Baroda buy. We have seen strong range breakouts on the short-term side, and 114 and a half stands out to be a strong, very strong support or retest of, I would say, breakout zone. So at 115, one can look for a trading opportunity on Bank of Baroda for the target of 118, 119 on the upside, and one can keep a stop loss of 113. On the index side, I would again repeat to go long on Bank Nifty rather than Nifty.
Got that. We leave it at that, Brijesh and Ruchit. Appreciate both of you taking on the time and sharing your thoughts with us on the show.
Well, let's get in our fundamental voice on the show. Mr. U.R. Bhat, Managing Director at Dalton Capital Advisors, with us on the show. Mr. Bhat, good having you. Thanks so much for joining in. Will it be a calm before the storm, or would you expect that it'll be yet another day of trade and business and nothing too much untoward?
I'm
referring to the obvious.
No, I think there would be peace. I think there's no point in having a showdown. I think better sense will prevail on both sides, and I think there'll be some sort of a middle ground found.
The markets have kind of given that indication that what they believe, right? And not just the equity markets. We are approaching that meet with a fair bit of uptick on the equity markets, 3 straight weeks of gains. The currency at 71.9293 has also not approached this with any kind of flutter.
Not really. I think there's a lot of background work that has gone on before this meeting. So therefore, I think they would certainly be. I mean, I don't think they'll play to the gallery. They would have some serious, mature talk, and they will sort of compromise.
So what does that do to markets then per se? Because we passed some major cues. The next big cue is probably the G20 or the state elections, and both of them from a world market perspective and India market perspective important. How do you think the next 20 days stay, because they are fairly crucial?
Well, I think the G20 would be very critical because based on what has happened in APEC, I think the tariff war seems to be extending. So therefore, that is something that we need to keep a close watch on. Plus, of course, there are other, Middle East is in the boil. You have Brexit fears. I mean, all unfounded fears really playing out very starkly. And the US continues to do well, so therefore I think it's attracting quite a lot of money there. So therefore emerging markets are not exactly going to be the great favorites in the next 20 days, as you said. But domestically things seem to be all right, except for especially the results have been reasonably all right. So therefore I think till now we were always saying that the results will start picking up, and the market ran up because of that. Now the earnings growth is coming, and the market is somewhat skeptical. So it's somewhat ironical. But the fact is that there are enough uncertainties on both the domestic and the international side. So therefore, I don't see the market running up dramatically from here.
What about the recent FPI numbers? I mean, for the month of November, the first half, nonetheless, has been encouraging. We've got already $1 billion worth of investments that have come in. Is that laying ground for what could happen in the near term, where more money could come in?
Well, I think yes. I mean, because that was the time. That was the time when things were reasonably secure. But right now we have these uncertainties coming. But given the sort of outflows that we had for the last several weeks, I think this was a small-time correction, as it were. But I think the level of uncertainties are not going down anytime soon. So therefore, I think market would probably find it difficult to take it up from here dramatically.
Right, but the domestic money is still there. It's going strong on a month-on-month basis. So does that provide a little bit of a kicker?
Indeed, I mean, that's the only one that has been supporting the market for so long when the FIIs were selling. I think it can support probably $1 billion to $1.5 billion per month, but not more than that. When you saw that FIIs were selling a bit more than that, the market's really corrected. So therefore, I think to the extent of about $1 billion per month, I think the FIIs, the domestic savings can support. But much more than that, if it is there, I think markets can correct.
Why do you say that for you, you're saying that the earnings were okay this time around?
Earnings, I think, for the first signs of pickup we saw. Till now, we've always been trying wolf, saying that earnings are just around the corner. But I think for the last probably 7-8 quarters, we were saying that, but nothing happened. But this is the first time when we are really seeing some pickup in earnings, at least in some sectors. And so therefore, there is reason for cheering. And the market also has corrected probably something like about 9-10% from the peak, even at these levels. So therefore, I think from the fundamental side, things seem to be all right, except on the export side, on the oil side, I think there is still uncertainty. But otherwise, I think there's a reason for the market to be sort of stable around these levels.
Right, but just to highlight for us, where were you encouraged in terms of seeing earnings? Because there are still a lot of downgrades that have come in post earnings in terms of the EPS downgrades.
Well, if you see the industrial side, and if you see some of the banks, the better banks have done well, then only there has been some problem with NBFCs. But other than that, even the auto numbers have, of course, probably been slightly slowing down. But nevertheless, I think that is one sweet spot that we have seen, because even when the economy was not doing well, that is one sector which continued to progress. So therefore, I think in these areas there have been some, for example, even in commodities, things have been very good. If you see steel results, they have been quite encouraging. So it's first time you're seeing double-digit earnings growth in at least some of the sectors.
Okay, what was the most impressive earnings highlight for you? I mean, small companies like paper sectors have done really well. Specialty chemicals did very well. Capital goods, Siemens today has done very well. What does that stand out for you?
Well, I can't talk stocks, but
engineering
and industrials, I think, for the first time has started showing some uptick there. So I think that is sign of an economy which is really, doing reasonably well from the lull that we saw for quite some time.
Interesting. Good enough for you to go out and contemplate making fresh investments there, or is it still in the realms of observing these companies and then taking a call once more print comes in?
I think you have to put the foot in the door because there's some uncertainty over the next, say, about a month or two, and so at that time there might be further correction. So you can probably increase your stake. But otherwise, I think this is the time you have to start nibbling.
Would you say the same for corporate-facing banks? Because while there were earnings downgrades on the back of the fact that provisioning numbers increased, there was the silver lining of the fact that new slippages didn't increase that much more. So you see us making a top in terms of the NPL cycle?
I think so. NPA cycle, the worst of the NPA cycle is behind us, I think. Now, even public sector banks' results, if you see, quite a lot of them have, they continue to make losses. But I think the losses are not increasing, at least dramatically. So I think there is some hope in that at that end. And of course, for public sector banks, the recapitalization is a big issue. But as you said, the corporate-facing banks, private sector banks, I think there's a lot of hope there.
Now, I have a follow-up actually on banks, Mr. Bhat. A few people, large investors, have now started talking about increasing their bets on the mid-size and small-size private sector banks. So everything from a federal to a DCB, at times even Karnataka Bank comes back into the stocks of making a fresh investment in as well. How have you looked at that pocket? And do you believe there is a case for a fresh investment there?
Well, I think even these mid-sized private sector banks, the old private sector banks, as it were.
Yeah, the old private sector
banks. I think there's a huge opportunity there because almost 50% of the banking system is not able to lend. So therefore, there is a huge opportunity there. Some of them are capital stout, but if they can raise capital, I think there's an opportunity there for them to really capture the growth momentum that is there in the economy, and I think they can give a reasonably good account of themselves.
But it's a story, Mr. Bhat, that has always come in the past that okay, this time around they have the opportunity opportunity, but they've somehow, even if the banks may have done reasonably okay, they've been pulled back by a number of issues and they haven't quite created wealth in a serious way for investors. Can this time around be different?
Could be. I think this sort of opportunity, this size of opportunity has probably not presented itself. But I think capital is a big issue there. So they should be able to raise capital. And if they're able to raise capital, I think they can capture this opportunity and make it look like this time it is different.
For most of the public sector banks, there's still a lot of capital requirement.
Correct.
Do you see that being a key challenge for them?
That is a huge challenge for the last couple of years now. But I think the government has to do something about it.
Not just growth capital, but capital to meet your regulatory requirements.
Well, I think quite a lot of them are just below that. That is why you have 11 banks under PCA. So therefore, I think this matter has to be addressed. I think it's very serious. You cannot have India growing at 7-8% without 50% of the banking system participating in it. So therefore, it is a very serious matter. Some, I think, solution has to be found. I think government will probably do this sooner than later.
One pocket, that probably from Q1 to Q2 saw a fairly divergent move was the cement pocket. First quarter realizations were better off and volumes also picked up and it looked like a pocket of interest. Come Q2, it seemed to have probably reversed its way backwards. What's your sense?
Well, I think this is one sector which would probably have a secular growth. But I think there are huge capacities being created, which is actually not giving them enough pricing power. But they will probably, the steady growth is reasonably assured. But I think pricing power sort of returns and goes off depending on commissioning of new capacities. And of course, I think valuations are a bit stretched there. But I think this is a sector which is an important sector to keep watching. But I think when the market probably corrects, you can probably...
But also a function of the kind of infrastructure activity that we're expecting to take
that has been quite robust. Infrastructure activity has been quite robust. That's why you continue to see growth. But it's just pricing power that's a problem there.
Interesting. In today's session, by the way, Yes Bank is now up 5%. And my last question is related to the next 2 or 3 stocks. Eicher Motors, 2.5% higher, so 25,000 from those lows of 21.5. back to 25,000. Maruti from those lows of 6,500 back to about 7,300, 7,400. A pocket that almost everybody believes written off, the growth numbers won't come in and the results didn't do justice either. But the market buoyancy has led these back. What does one do with some of these premium valuation auto names, be it a four-wheeler company like Maruti or be it a niche two-wheeler like Royal Enfield or Eicher Motors?
Well, I think quite a few of them have disappointed in terms of the last quarter numbers, but I think it doesn't say anything about the secular growth story that is still in place. Valuation is always a point of discussion, so therefore I think some of them are really, I mean, you said premium, they're super premium, some of them, but I think at the right juncture when there is some correction in the market and you have opportunity, you should be holding on to these stocks because these are secular growth stories.
What else do you like? Anything that flew for you?
Well, I think it is just private sector banks continue to do well. Then you have pockets of auto and industrials. I mean, these are the sectors that you need to be in.
All right, we'll leave it at that, Mr. Bhat. Thank you so much for joining us. Appreciate it.
Thanks, Mr. Bhat.
Pleasure. Thank you.
All right, the market seemed to be doing okay. The Nifty Bank, not so. It was leading the charts last week. It's not quite doing that in today's session. Very, very flattish for the Nifty Bank relative to the large caps. The Sensex still about 200 points higher, and a bunch of stocks in the pharma space too doing reasonably okay for themselves. But and Yes Bank, by the way, just need to mark that one. It's up 6.5% at 203. So being put under watch or otherwise notwithstanding after the fall that we've seen, a strong pullback move that we're seeing in the stock of Yes Bank. So that one remains the top draw. 13 million shares done already. It's not a small
Samir was talking about it. He said they started buying at about 185, 190.
Yeah, so interesting. Anyways, let's take a break on that note. On the other side of the break, though, we discuss the most important event for the day for the Indian markets, the power struggle between India's monetary policy makers and the government officials over RBI's capital framework with Indira Rajaraman, who was the former member of RBI's central board. And then, as India's largest media company makes its attempt to become technology resilient, we take a look at the dynamics at play with an industry veteran, Ronnie Screwvala. He speaks a lot on what he makes of the Z promoters' decision to pair stake. Both of those discussions coming up in just moments from now.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back to Indian Open. A review of RBI's capital framework that governs the reserves in the central bank's coffers and the dividend it pays to the government is on top of the agenda at today's central board meet. Another bone of contention between the government and the Reserve Bank is the liquidity crisis faced by NBFCs and how to tackle it. Ira Duggal caught up with the former RBI board member Indira Rajaraman to understand what's at the core of these issues better. Listen in to what she had to say.
There are essentially three components to the RBI's reserves. There is this valuation component, which has increased over time because the value of gold has increased, and there is the valuation of foreign exchange and valuation of domestic securities. The third is a very small part, but the gold and foreign exchange are a big part of that, and that amounts to nearly 7 lakh crore. Now, although these reserves, this particular part of the reserves, can really be realized only when the asset in question is actually sold, and since gold is not going to be sold, there is an issue as to whether the foreign exchange holdings in that valuation reserve should be sold and the gains realized, and thereby become available for whatever the RBI may, in its wisdom, decide to do. Aside from this valuation reserve, there is an asset and development reserve, which is just like depreciation reserve of any company. I don't think it should be touched. It's also very small. And then there is a contingency reserve. Now, the contingency reserve is in principle something whose size can be worked out by people who have the technical expertise to do it. The contingency reserve, as the name implies, is for unforeseen contingencies. But even so, just like an insurance provision, its optimal value can be based on actuarial calculations. You need people very technically qualified to do that sort of thing. My surmise is that within the RBI, either a committee or the serving officers in the RBI should in principle have worked out what the optimal level of that contingency reserve should be. Certainly the committee that I was a member of, chaired by Mr. Malegam, did not look into this at all. It didn't look into the adequacy of the contingency reserve, the optimal level, based on any kind of technical calculations. So I myself am not privy to that. But my sense is that overall, when the RBI confronts a hostile board with government nominees wanting to know why the reserves are at the level that they are, the RBI should in principle be in a position to discuss the issue without necessarily giving in any way. I think what they have to do is to marshal the calculations that they have done, justify the level of the contingency reserve, and be open to a discussion of whether the valuation reserve can be reduced in any way. What would not serve the RBI management well is if they were to refuse to engage in a discussion. That would not serve any purpose.
All right, ma'am, I have a couple of follow-up questions here. One on what is already accumulated in the contingency reserve. So there is what has been accumulated there and what may be added to it in the future. Is it feasible for the RBI to transfer, should that agreement be reached, to transfer what is already accumulated? And if so, what would be the implications of that?
You know, anything is feasible. So the accumulated amount in the contingency reserve is of the order of about 2.3 lakh crore. So let's round it off at 2.5 lakh crore. Now, supposing the internal calculations of the RBI were to reveal that they don't need that higher reserve, then they should be, in principle, be ready to present to the board what is the level that they think is optimal, given the volatility in whatever exchange rates, any other volatility in financial markets for which the contingency reserve is intended. And if they were to go with the board, with the government nominees on the board, and decide that some of that can be released to the government, that should be, in principle, possible, transferred from the reserves to the government's account with the RBI.
I think Mr. Maligam pointed out that the RBI Act may not permit it, but I guess these are issues that have not yet been discussed or have not probably been examined. My other question, ma'am, with the contingency fund is what gets added to it from here on, and I think that's where they're talking about having a clean formula. Now, you know, in 2015-16 in the RBI annual report, they talked about this new capital framework. They actually didn't put it out in public domain. So the only benchmark we have is that 12% number, which was put out by a committee long time back. Surely there's nothing wrong with the capital framework being in public domain and having complete agreement between the centre and the RBI on it?
The reason I'm against numbers like 12% and so on is that the RBI, as the central bank, which is a massive responsibility, because the RBI is in a certain sense a guardian of financial stability in the country and of the financial profile the country presents to the external world, to international capital markets. It's a very, very important responsibility. So if the RBI does not want to commit itself to a number like 12%, I think that's entirely all right. If in the considered judgment of the RBI they don't want to commit themselves to a number, they should in principle be willing at all times, though, to defend the level of reserves at wherever they are. And even though under Article 58 of the RBI, there is no provision for the board to actually direct the governor to reduce the level of reserves and hand it over to the government. In that sense, there is no provision in the Act for such a thing to happen. At the same time, as far as I am aware, the Act does not actually prevent the governor from deciding on the basis of discussions with his senior management that such a transfer is in the public interest. So I don't see that there is any provision that says such a transfer should not be made, but the Act probably does protect the governor from having to do it against his will or against his better judgment.
Okay. Ma'am, a question from the government side. This issue about whether adequate dividend is being transferred to the government came up last year. It was an exceptional year because of the demonetization costs. This year, again, the RBI in its judgment has transferred some money to the contingency fund. The government is squabbling that it's not enough. All of that seems to be coming in from the fact that the government needs more fiscal resources. That shouldn't be the deciding factor by any means. And even in your comments, you're suggesting that it's the RBI's judgment, not the government's.
That's right. The RBI, according to me, is the sole judge of what is needed for the financial stability of the country and for the financial rating of the RBI itself as an institution in international markets. This is paramount. The RBI has to do its own calculations, but be prepared to present those calculations to the board. Not to say, this is what we think is right. They have to say why they think what they say is right. It's very important in these things, now that things have come to such a pass, that this dispute has come into the open, that the RBI should not become a victim of the Latin liturgy syndrome, under which, if you remember in the church, the sermons and were all given in Latin, and the lay people in the church couldn't understand what was going on. So the RBI has to be willing to step down to the board, present the calculations, defend the level that they think is optimal, and carry the board with them. And that is terribly important. Certainly what you say is right. If there is a reach into RBI's reserves in order to fill a hole, a fiscal hole in the Government of India's budget, that would be an appalling situation, an appalling precedent, and should never be allowed to happen.
All right, Dr. Rajaram, allow me to move to another subject. I think the reserves have caught most of the attention, but I think as you've written in two recent pieces in Mint newspaper, perhaps more immediate are two issues. One is of the NBFC issue, which you wrote about, but I'll add the issue of banking regulation. On NBFC, ma'am, I think, the initial judgment, even in your piece, was that the RBI was doing what is required. But market participants, for instance, don't seem to feel that it's adequate. Liquidity is still deficit. The flow of liquidity from banks to NBFCs is still fairly curtailed. Do you think that the RBI needs to yield some ground on this NBFC issue?
Yes, it does appear to be the case that the RBI has probably been too stringent in terms of its willingness to consider the liquidity needs of the NBFCs. This is a serious financial crisis that we're facing right now. It could have a systemic impact. Moody's, in its latest report on India, has itself remarked on the credit squeeze facing NBFCs, but has said that so far it doesn't seem to have any systemic consequences. It hasn't had any so far, should not have any. Once again, the RBI is the best judge of whether we are approaching a systemic crisis, but definitely I think the RBI needs to consider once again the issue of the liquidity sufficiency for NBFCs, consider all the issues, be willing to give a little on that matter.
And the fact that NBFCs, unlike banks, can't directly borrow from the RBI obviously is a hindrance, ma'am. But there could be designs of ways to do this where you're not actually bailing out entities which may have run business risks too high, you think?
Yes, of course. There are many ways by which this can be organized. Various ways in which special repo windows can be opened. Multiple ways by which this can be done. At the end of the day, it's a matter of whether the RBI decides to give in a little, not because they are becoming lax in any way or imprudent in any way, but simply because of the need of the hour.
Sure. Ma'am, also there is a conversation around the need to be a little bit more accommodating towards SMEs. On the data front, one doesn't see where additional stress is building up on SMEs, but one fully recognizes that SME data is not that easy to sort of judge. A lot of stuff happening on the ground which doesn't reflect in the data. What is your sense? Demonetization, GST, now NBFC, there is probably reason to believe that SMEs have some support requirement?
Actually, NBFCs were the ones who were meeting the needs of SMEs. NBFCs, as you know, are closest to the ground. They were taking care of last mile liquidity needs of SMEs. And so I really think that if the liquidity needs of NBFCs are taken care of to some degree, though not to the entire extent needed, maybe the needs of SMEs for credit would be met more than they are presently. I should also add that in February February of 2018 or so, the RBI did introduce a forbearance in respect of non-performing assets of SMEs to the banking sector, which had arisen because of GST. If you remember, the initial design of GST, which was in place for 3 months, meant that SMEs were in sudden need of working capital on account of GST payments that they had to make on payments that were themselves delayed. But they had, you remember, there was monthly payment, monthly filing. It was very stringent in the first 3 months. And many SMEs, which up to then had absolutely no history of default, suddenly went into default. So the RBI was aware of that, did yield on that, did extend a 180-day extension forbearance for SMEs, which had previously had no record of default, but went into default because of the initial design of the GST. So it's not as though the RBI has been completely insensitive to the needs of SMEs, but at the moment, I think the need of the hour is to focus on NBFCs, especially the smaller NBFCs. There are 11,000 NBFCs in the country, and the NBFC space is very skewed. There are some dozen or so NBFCs which are very large, and the rest of them are small, regionally dispersed, serving the needs of SMEs all over the country. So I think if the liquidity window for NBFCs works in a regionally dispersed way, I think that will be the best way of tackling the needs, the credit needs of small-scale industry.
You can catch Ida's full interview with former RBI board members Indira Rajaraman and HP Ranina 11 a.m. onwards. All right, the next conversation. Zee Entertainment's promoters want to halve their stake in the company, a move that's not been well received by select sections of the markets and brokerage community. But Ronnie Screwvala, one of the country's most prominent media entrepreneurs, says it makes imminent business sense. Speaking on BQ Conversations, he says a strategic investor with the know-how of being an online tech operator will actually help Zee. Hear out his rationale.
I don't see this necessarily as something which is an intent to exit, and I don't see this as something which puts them in an incapable position. Personally, my sense of the promoters is, as you've rightly described them in the beginning, they've been pioneers. They're 5 steps ahead. They've understood trends. They've built a sort of an integrated and multimedia business. And I think from that perspective, when you look at trends and when you look at crossroads, your ability to preempt the next trend and figuring out your strengths and weaknesses is a good time for you to re-evaluate exactly what you're looking at doing. So I think for them, their perspective, they're not just a broadcaster, they're not just a content supplier. I think they have built a multimedia business, and if you look at the divergence in which they do that from the element of content to the element of platforms, and now multiple platforms, because I think even their Z5, they've been able to scale it. The crossroad I think it is at is now, given the other companies that are coming into the fray and the way audiences are consuming everything else. So I think what Subhashji and the team there and the founder promoters are rightly looking at is, we can look at it as a business, but at the end of the day, how is the consumer looking at it? And I think the shift that he's seeing is, how is the consumer, who is my consumer, how is my consumer going to consume, and what is he looking at it? And if I don't preempt that change, I could be an anachronism.
Interesting. Okay, I mean, there was, of course, if I look at the research reports that came out, and people who track the stock per se have spoken about how there could have been other reason of business compulsions and other businesses too, but I won't get into that with you. My question to you would more largely be that from a perspective of somebody who's built such businesses as well in the past, is the tide looking favorable enough for somebody and such a large media house to get in more funds, yes, but keep their shareholding in this business intact, versus stating an intent of liquidating 50% of their holding in that particular business? That's the dichotomy, I think, in the minds of people, that if indeed the business was looking so favorable, why liquidate only their stake? Why not get fresh funds into the business?
You know, I think this is an age-old thing which only comes up in India. The minute you're sort of not 100% owner, you are already working at it on a largest framework. The minute you're not a 51%. So I think this control context in India is sort of over-dramatized. I think to answer your question sort of very directly, I think the fact is They can raise money at the company level, or they can raise money at the holding level. I think the context for them is really what is somebody going to be able to bring to the table along with them to take it to the next level. And I think the question of today, I think given the competitive environment, yes, I think it is the question of how the audience is going to look at this. What do I need to do? Is the investment in technology? Is the investment in content? Is the investment in customer acquisition? I think what the asset base here for a media company like Z is really their footprint and their footfalls, as I would put it. Their connectivity with the audience, the brand recall, their access and ability for that kind of viewership, and the mind share of audiences. If you take all of that, that's a substantial asset. Now, I think it's up to the founder group to figure out that, do I want to look at this as I'm fine to be a 20% shareholder instead of a 40% shareholder? Because I think today, if you look at it, most growth at scale is going to happen through collaboration and not necessarily on a competitive basis. Now, there'll always be those massively huge companies that will say, winner takes it all, or kill the competition and that's the way I'm going to grow. But for most other companies, I think it's going to be a much more an era for the next 10 to 15 years of collaboration more than even consolidation. Because consolidation sometimes is, you know, 2 and 2 coming together, and many times it becomes 3, it doesn't even become 6, because there's erosion between culture clashes, assets, why the two companies ever got together, and sometimes it even comes to a 3. But collaborativeness, I think, will ensure that 2 plus 2 is much more than 4.
They are very well known, Mr. Screwvala, as content providers who actually make content at a fairly economical cost as well. Z is. You know, I was speaking to Sameer Nair a couple of quarters ago, and to his mind, the discovery of content with all of these platforms throwing up content at the rate of zillions is the biggest challenge. Do you think any media house in India currently needs to have a partner which enables them to, one, reach more people, and then to have their content discovered well? And would that be the kind of partner that a house like Z would be looking for as well? I mean, I'm just asking you to put yourself in Subhash Chandra's shoes, because you've built such businesses in the past.
And I would say no, because the simple reason is it's not I mean, everything is a content play, but this is not much more about how do I get somebody to collaborate to figure out content. In fact, I think most multinationals have struggled with a sort of a culture and a context of India to localize. And I think Z's cracked it, not just in terms of economics, but just in terms of the reach and understanding the consumer. So it's much more, what is the consumption pattern of even content? So I think the partnership there is going to be much more about technology, deeper understanding of the consumer and the audience, how to mine data, because actually the biggest things that are happening with the social media companies or the Apples or the Facebooks of the world today is exactly how they look at data and how they mine that. Those are things you can say, I'll bring in people and I can start it as a division, or I can just leapfrog and say, even if I do it for the next 5 years, I'll be able to get to this level. But if I bring somebody in and the 2 plus 2 becomes much more, I can leapfrog. And I think it also has to do with a lot of the competitive environment that's coming in here, right? Because you have a consolidation with Disney and Fox, which in India means Disney and Star. You have on one side Jio, which is no longer a telco company, and is a sort of not even a multimedia company in many aspects. And between them and the media assets they already own with an equally robust competitive network, you need to look at that landscape also and say, how am I going to be 3 steps ahead of what could be a competitive environment in any case?
The more things change, Mr. Screwvala, the more they remain the same. Would you believe that storytelling in India would need to change? Because hitherto we've been a country of content providers who are largely making daily soaps, 1-hour videos that are told, or 1-hour content that is told almost every single day, 5 days a week. Now we have the advent of Netflix and Amazon Prime, which to a person like me in an echo chamber like Mumbai seems to be doing very well, but don't quite know the pulse of India. What do you think happens to a content player like Z or a Star or somebody else over the next 5 years?
So I think, and I'll answer the last part of your question separately, but I'm a firm believer in and versus or, and especially in the segment of storytelling, audience reaction, audience consumption patterns, and media overall. It's about the and. So it's not about a knack of storytelling that's going to replace anything else. It's the fact that if for daily soaps, which is the staple plate, and that appeals to about 250 to 300 million people of your core audience, that's not going away in a hurry for a fair period of time. But what is happening is every year, 20 or 30 million people are moving out with fatigue on that, either that or consumption patterns, or are not looking at television, and therefore need to see it either on a different platform or culturally have moved forward. But there's a new ground of another 10 to 20 million people in a country like India that's always coming in. The people who've in some form become more aware, have become accessible, have entered the lower middle class level, can now access that. So that trough of that, what I would call middle common denominator, will always stay there. So now you've got the millennium segment and the early millennium, and even now that's going to get redefined, and the people who drop out. And that's really, today in any other country they would be called niches, but here they can be 10 million, 20 million, 30 million, and 10, 30, 20, 30 million in a country is almost 100% penetration of that market. So those are large niches for people to follow. And I think that's where it's going. So specifically, it's about an and not an or. I don't think we're going to find replacements as much as we're going to find a broader base of consumption, broader base of different storytellings, because otherwise, till 5 years back, when you're talking about that change, most storytelling was to the largest common denominator and on a common platform from television, where you couldn't experiment and say that from 7 to 10 I'll tell you these stories, but after 10 I'll tell you those stories, because you couldn't find that niche. Which is why the 5 mainstay general entertainment channels, when they had the soaps that were working, it was a damned if you do and damned if you don't, in that you can't replace them. So then they would start the flanking channel. So everyone had a flanking channel and a separate channel that almost addressed a new audience. And then they realized that actually those audiences were moving out of television viewership totally, and they now have to find them on a different medium or platform. So, and to answer the last part of your question of therefore what do players like Zee, Sony, Viacom, and many others do, and I think to that extent they are addressing that, because I think if you look at Star's flag bearer, is really Hotstar, and if you look at them and what gets the buzz there, there's a lot more focus on the digital medium, not necessarily in content. You'll add 5 more channels to your bouquet. You already got 55 channels or 100 channels, you're going to add 5 more. That's not going to move the needle. HD versions of them, or a plus here or a plus there, is not going to move it.